positions?
Good. Everything is, we went into Friday. Friday was, I'm off the mic on Friday, so I was able to actually to do some trading and stuff. But just looking at my research from Friday, and how I usually use the multiple time frames and use some of the patterns and stuff. I'll just show you my chart, and I'll get your opinion on it, because I know we look at the similar things when it comes to trends and stuff, but we also you have a different way of looking at market volume profile, and I love that, so I add that into my charts, and I think we have a perfect, what we call the all-star team of indicators on our charts here. Mm-hmm. But if we go back here for the last a year, basically, the last year, we have a standard rotation here. We have a lot of flags, a lot of pullbacks. Stochastics here get oversold. We bounce out of it. We pull back. We flag, get oversold. We move higher. We flag. We pull back. We move higher. We flag. We pull back. We move higher. We flag. We pull back. We move higher. We chop around a little, but right back here now, we're back in that same situation. And this is what we were looking at last week. There's an important thing that I've studied over the last 10, 15 years, and it's the way the stochastics tend to coil up. When we see this pattern here, the lower highs, and we kind of tighten up, there's usually a big, everything gets compressed, and there's usually an underlying tight channel underneath it, and that's a timing trade for me. And we look for this, even though that might be a small channel, relative to whatever we're looking at, we usually get that move out of that tight formation. In this case, we did. It wasn't a big move, but it was enough of a move to rotate us back into an overbought level, pull back here quickly, and then cross back up and kind of maintain that daily time frame now, which is starting to turn back up. So we're looking at, I'm looking at, things that are happening, that happen over and over again. What's going to hold this market back from just taking out the highs again?
Yeah. To complement what you're saying here, for most listeners, you have to remember that the first step is identifying what time frame you're talking about. So here you're showing us a daily, then you broke it down to a 60-minute to show those compression zones, right? That's what you did. Yeah. And that's what on my sheet I identify as chop. Those compression zones tend to be areas where the reason the market sits there sideways, like where you have your ellipse there, the yellow ellipse there, you see how it's kind of like this stochastics are just going sideways. Yeah. Those are what I call chop zones on my chart, and those are, chop zones is kind of like the layman term. It's balance, and the market essentially moves to an area, and it cannot find enough higher time frame pushers to keep it going, so it just sits there with shorter time frame traders trading together. Yeah. Stochastics are built on closing prices over a look back period of whatever, 14 over 21 or whatever you have, 14, 14, 21 or something. And it's basically your line, your stochastic line is just showing that balance taking place. And on my charts, it looks the same. You have that on your chart here. You look at where it says March 10th through the 12th. You could see how it's skewing down, but the bars are overlapping each other over and over and over. And that's compression. That's what we call balance. And on my sheet, those are the chops. Those are the green zones, the chop zones. That's where we expect the market to go into that sort of behavior. And so this time around, it did not actually push far enough. I mean, it pushed into a big chop zone in the 2039, 2037 area and kind of held it. But it did not... It could have pushed a little bit further. It could have pushed a little bit down into the 2026 area, and that would have been a much stronger base, in my opinion. But my numbers that you see there are identifying the chop zone before it happens. It's a best guess, so to speak, as to where that consolidation compression stuff happens that you see on your stochastics. And your stochastics is showing what had happened. Of course, the stochastics are looking back to see what has happened. And of course, a lot of people trade off of that. They want to see that it has happened before they get in there. But we want to anticipate, my goal as a trader is to anticipate where that might happen, and then identify where can I enter into this if it holds, and where do I get out if it doesn't hold, or if it doesn't hold, where do I get in for the pullback and go in a direction of the break. And that's what the sheet's about. The orange line is a major area to be tested. And I put that at 2074, 75, or 2075 or so. And you're looking at the S&P. You're looking at the S&P cash. These are futures prices. The price difference is about 7. You have to reduce the cash prices by about 7 points, 7.5 points to get the future. So you can see the futures are trading much lower right now in the 2065 handle. So we have some room, about 10 points of room before I would say that the sellers should start getting worried and maybe putting on some options to hedge their position if they want to hold on. But so far, this morning I anticipated the run up through 59. I did expect a push lower in the morning towards 50 or so. That's what I put in my morning trader bite. But the market was not interested at all in selling this morning, and the overnight session just showed it so strong. But it kind of sat sideways at the open for about 15 minutes, and then it broke higher, and it just never looked back. Right now, the target for the day is 2067.75. That's a short term line that I didn't level that I didn't put on the chart here, because it's once we tag it, it's no good for the week. So. But overall, this is where the market's chopping around. What's setting up for the week is a whole heck of a lot of central bank talking. I mean, if you look at the calendar, holy cow, the ECB has like 9 engagements, and then you have a bunch of Fed speakers. Then you have Japan's Kuroda coming on to talk about monetary policy. You have Yellen on Wednesday. You have Draghi on Wednesday. It's pretty insane. These people have gone from being nerd economists to like rock stars. You just see them everywhere. Pretty soon they'll be doing commercials, I think.
Yeah. They'll be. I'm surprised they don't have their own reality shows going on yet.
Absolutely, a lot of money in that. But this week, I would caution listeners to. Not get yourself too involved in any particular position, because we're going into this Fed Wednesday, and the market's again playing puzzles with words. It's like we're looking for the word patient to be replaced with some other synonym. And of course, given the unemployment figures. The market's anticipating that the Fed may raise rates sooner. I'm not in that camp. I do not see the Fed raising rates. I see the Fed threatening the market, but I see it not raising rates, as China and Japan and everybody else is dropping rates. Us raising rates means we kill off all of our capital goods exports and all of our exports, essentially, and I don't see them doing that just yet. So, the euros dropped from high prices to reach $1.04, $1.04.5 last week. Pretty insane how fast that thing dropped. It's like a crude oil drop. Crude oil's also come down. Was holding pretty decent prices, and then it hit a low of 42.85 overnight. So overall, I think there's just not much for the Fed to do other than to kind of throw false punches at the market and see if we flinch. So that's how the week's shaping up.
Yeah, there is a lot of a lot of news and data coming out that's going to play havoc. I mean, the interesting thing about the FOMC is you have that volatility that comes in. Sometimes you get that spike in the range, and we could use that as targets later on in the week. I always enjoy that. I always enjoy watching a flush or a pop, and then things kind of even out, but we slowly move back to the scene of the crime.
Exactly, scene of the crime. Yeah,
So,
yeah, and I always encourage people to record where that is. Like, know where your high was and your low was for unemployment when that number comes out. Know where it is for FOMC. At least those two numbers, you should know where it is.
yeah.
If you're trading, a European-based product, you should know those numbers for the ECB. You should know where the euro went, what the euro range is on the ECB announcement and conference. Those are really important test areas. Those are the most truthful, in my opinion. Those are the most truthful levels, because it really shows you where liquidity came in to stop a move, the high and the low. It shows you where people actually truly saw it as too expensive or too cheap. And that's what this trading is all about. The only reason you buy a stock or sell a stock is it's because you think it's relatively inexpensive or relatively expensive, depending on what position you're taking, and to the volatility that comes with FOMC and NFP and unemployment and so on. It's like a very honest view of where participants thought, man, that is just too expensive. Let me sell it. Let me dump my shares. And you should record that line until the next month, when until it's tagged, until it's tested, or until next month when the next flush or spike happens. Those are important milestones in the market, in my opinion. So I completely agree with you.
So let's get back to this midweek announcement, the FOMC announcement. This will probably, push the market in one direction or another. A lot of times we'll see it come up to a level that you have marked off. What do you, just a harder question though, but what are you looking at into this meeting? It's such a hard guess what they're looking for the commentary to change a bit. They're looking at any type of clues if we're going to raise rates sooner than later. Do you see this as an opportunity for the market to pull back further? And then what's the other question I was going to ask you today? What is the key level? You mentioned earlier when you first got on, there's going to be a level that maybe sellers should start to protect themselves as we get through. What level are we looking at this week or in the future that once we get back, that you're gonna start to say, hey, this is looking stronger. We're going to actually take out the highs again.
Yeah, so I'll answer your second question first. The level I'm talking about is at orange level 2074.75. If we take out the 2074.75 at a session and continue to push above it, or to balance above it, or flag above it, the breakout of that flag is going to likely quickly target 83.50. And that's the narrative here as you read up the ladder here of levels that you show on your screen. The next level up is 83.50, which is a big volume area. If sellers cannot step in and defend this area, then the next test area, which is likely to be a quick test, is 93.75. If we take out 93.75, the next big test area is 2103. If we take out 2103, new highs are imminent. Yeah. So there's quite a bit, we've left a lot of structure up there from the last few weeks, but 74.75 creates a cascade. It's like the Normandy line. Once you take Normandy, now you can push into France, and now you can start moving towards Berlin, type of thing. And this is what this is. This is a lot like old style battle fields. Kind of like you take a territory, then you set up camp. Setting up camp and trading is that balancing, flagging, stochastic sideways stuff, and then if nothing gets, if that area stays firm, then you have a lot of trading that happens in that area. One side is likely to be wrong and get squeezed, and so now it's ready to push to the next battle line. In this situation, 2074.75 to 83 to 93.75. And then 103, and then if 103 is not defended at all, look for new highs 2110, and then I would my target above the 2103 would be 2020, which gives you quite a bit of distance, but it's a multiple level target up there at 2020, which I think is the next level up. So that answers your second question. The first question is, what is likely to happen here into Wednesday. I think we're going to probably we're running up today. No, the narrative since last Tuesday is gap down, sell off. Wednesday sideways. Thursday gap up, take back all of Tuesday. Then Friday gap down and take back all of Thursday. And then today gap up and break through Thursday and Friday's highs. Typical balance kind of behavior, frustrating trade for many, but if you step back and see it for what it is, you can kind of anticipate it. I think we continue to drift sideways, but with an upward skew. I think the market's likely to drift towards that 74, 75 before the FOMC. I think it's likely to take another stab down. We still don't have what I would call a firm base below us to launch from. I think there's still some weakness below that has not been tested, but I think most of it's going to be pretty wide-ranging chop like we're seeing today until the FOMC. The FOMC overall, we're still near highs. The highs are 21.10 in this contract. It's not that far out. It's 40 points out, 44 points out. So it's not that far out. I think we're likely to drift towards that high again. I think we're going to follow another cycle like you showed with your S&P cash chart, where we're going to pull back. The Stokes are going to go way into oversold, go sideways, then start to turn up and then accelerate to the upside. I think that cycle continues. There's, you and I have been doing these Monday things for a long time now, and every time I get on here, I say, mind the big trend. Be aware of what time frame you're trading. I think that's the biggest thing that just doesn't add up for most traders in their heads, is that you have to identify. You can't listen to someone on TV who's talking about, according to the Dow priced in gold terms is actually a lot weaker, and sit there and go, yeah, I think I'm going to be bearish, and then come in here and day trade. Well, that guy's talking about 100-year cycle, and you're trading in a day trade. You have to kind of be aware that the market is in a massive uptrend. It's one of the biggest bull runs we've had in a while. And these pullbacks have to be, you can trade them, you can get short, you can pound on the short side when the market's rolling over and trending, but understand that the overall forces, the bigger waves, are on the buy side, and so the highs are continuing to be vulnerable on every pullback until we just cannot push those highs anymore. And it'll be very obvious when it happens. It'll be like March 2000 or September 2008, where it's just like, holy cow, the entire barn is burning down.
You're afraid to get up in the morning.
Yeah, you don't want to open. When it gets to the point where you don't want to open your statements, that's when it's probably a time for you to get short or get out of your lungs. So that's where we are. I cannot predict where it'll be, obviously, for NFP, but I know that the 74.75 is an important line that this product has to battle, and I think we're going to be stuck in this 83 to 63 zone until that's sorted out. But we'll see. Anything can happen from here to there.
Awesome job, FT. So you think we have a shot? What's our high for today, you think?
I think we still push to 67.75, possibly 68.50. I think we continue higher. I have no reason to believe that that this thing is done. I see, like, the underlying markets, the biggest 5 sectors that you'll want to track if you're looking at the S&P 500 are, and I'll give you the ETFs for it. These account for over half of the S&P. They are XLV, which is the healthcare sector, XLI, which is the industrial sector, XLF, which is the financials, XLY, which is the consumer discretionary, and XLK, which is a technology. And all of those are up approximately 90 basis points or higher. The healthcare sector is up 2%. Very bullish underlying so far. I'm not seeing, the breadth of the S&P opened somewhere in the plus 300, and it has not given up any territory on the downside at all. To me, it just seems like it seems fairly strong. That could change at any second. But I don't have an argument here that's really solid for selling. Once it rolls over, I'll change my mind. I'm constantly changing my mind because I trade that way. But until that happens, I have no evidence to fight this just because it's way up or too high.
All right, excellent job, excellent. And maybe we'll hit you up during the week, right around the meeting, to see what happens. If there's any big reaction, I'd love to get you back on.
Yeah, if we blast through these levels and you see something you want me to comment on, please ping me and I'll be happy to come on.
Great job, FT.
All right, thanks for having me on.
All right, take care.
Take care. Bye.
All right, let me save this here. We'll get this out to you also.